welcome to your audience, students and scholars. Here I am Dr. Amjad Ali. In this video we will learn measuring the value of economic activity, gross domestic product. Dear scholar, there are a number of measures are available to measure the value of economic activity, but in this video we particularly discuss about gross domestic product as a measure to the value of economic activity. Gross domestic product or GDP is often considered the best measure of how well the economy is performing. This statistic is computed every 3 months by different institutions of the economy from a larger number of primary data sources. The primary sources include both administrative data, which are byproduct of government functions such as tax collection, education program, defense and regulation, and statistical data which come from government surveys, for example retail establishments, manufacturing firm and firm activity. The purpose of GDP is to summarize all these data with a single number of representing the amount of money or dollar value of economic activity in a given period of time. By talking about measuring the value of economic activity, gross domestic product, there are two ways to view this statistic. One way to view GDP as the total income of everyone in the economy. Another way to view GDP is as the total expenditure on the economy's output of goods and services. From either viewpoint, it is clear why GDP is a gauge of economic performance. GDP measures something people care about, their income. Similarly, an economy with a large output of goods and services can better satisfy the demands of household firms and the government. Economists answer this simple question, that how can GDP measure both the economy's income and its expenditure on output? The reason is that these two quantities are really the same for the economy as a whole. Income must equal to the expenditure. The fact that in turn follows from an even more fundamental one, because every transaction has a buyer and a seller. Every dollar of expenditure of a buyer must become a dollar of income to the seller. Like we have the example here, when Joe's paints Jane's a house for $1,000, and that $1,000 is the income of Joe and the expenditure of the Jane. The transaction between the two contribute to $1,000 to the GDP, regardless whether we are adding up all income or all expenditure. To understand the meaning of GDP more detail, we turn to a national income accounting, the accounting system used to measure GDP and many related statistics. Here we have the example income, expenditure, and a circular flow that imagine an economy that produces a single good bread with a single input labor. Here we illustrate that all economic transactions that occur between household and firms in the economy, we have the labor and the goods, and we have income and the expenditure. This figure illustrates that the flow between firms and the household in the economy that produce one good bread from one input labor. The inner loop represent the flow of labor and bread. Households sell their labor to the firm, and the firm sell the bread they produce to the household. The outer loop represents the corresponding flow of the dollar. Household pay the firm for the bread, and the firm for the bread, and the firm pay the wages and the profit to the household in this economy. So GDP is both the total expenditure on bread and the total income from the production of the bread. GDP measures the flow of money in this economy, we can compute it in two ways. GDP is the total income from the production of bread, which equals the sum of the wages and profit. The top half of the circular flow of money or dollar. GDP is also the total expenditure on purchases of bread, the bottom half of the circular flow of the dollar or money. To compute GDP, we can look at either of the flows of the money from firms to the household, or flow from the flow of money from household to the firm. Okay, so for the discussion of detail of GDP, we have here two types of variable in discussion, that is stock and flows. Okay, many economic variables measure a quantity of something, a quantity of money, a quantity of good, and so on. While economists distinguish between the two types of quantity variables, stock and flows. Okay, a stock is a quantity measured at a given point in time, whereas flow is a quantity measured per unit of time. Here we have a classic example of a bathtub. The amount of water in the tub is a stock, and it is the quantity of water in the tub at a given point in time. The amount of water coming out of the faucet is a flow. It is the quantity of water being added to the tub per unit of time. Notice that we measure stocks and flows in a different units. We say that the bathtub contains a 50 gallon of water, but the water is coming out of the fuel at a 5 gallons per minute. So GDP is probably the most important flow variable in economic. It tells us how much money or dollar are flowing around the economies in the circular flow per unit of time. When you hear someone say that the GDP of US is 14 trillion, you should understand that this means that it is a 14 trillion dollar per year. Here we have some examples of stock and flow variables. A person's wealth is a stock, his income and expenditure are flows. The number of unemployed people is a stock. The number of people losing their jobs is a flow variable. And the amount of capital in the economy is a stock. The amount of investment is a flow variable, and the government debt is a stock variable. The government budget deficit is a flow variable. So here we have the rules for computing GDP in an economy that produce only bread. We can compute GDP by adding up the total expenditure on bread. Real economies, however, include production and sales of vast number of goods and services. To compute GDP for such a complex economy, it will be helpful to have a more precise definitions of GDP, that gross domestic product is the market value of all final goods and services produced within an economy in a given period of time. To see how this definition is applied, let's discuss some of the rules that economists follow in the constructing this statistic. The first one is adding apple and oranges. While talking about every economy produce many different goods and services like hamburgers, haircuts, cars, computers, and so on. So GDP combines the value of these goods and services into a single measure. The diversity of products in the economy complicates the calculation of GDP because different products have different value. Suppose for example that the economy produce 4 apple and 3 oranges. How do we compute GDP? We can simply add apple and oranges and conclude that GDP equals 7 pieces of fruit, but this makes sense only if we thought apple and oranges had equal value, which is generally is not true. To compute the total value of different goods and services, the national income account use market price because these prices reflect how much people are willing to pay for a good or services. Thus, if apple cost of $0.5 each and oranges cost $1 each, GDP would become or GDP can be calculated as GDP is equal to the price of apple multiply quantity of apples and price of oranges multiplied by quantity of oranges. So we can calculate that point five dollar multiplied by 4 plus $1 multiplied by 3, and we get 5. So GDP equal to 5, the value of all the apples plus the value of all the oranges, we get the GDP. Okay, while talking about the rules for computing GDP, here we have to take care about the used goods and GDP. When a company makes a package of baseball or basketball cards and sell it for 50 cents, that 50 cents is added to the nation's GDP. But what about when collectors sell to the existing product and on the cost of $500, that 500 is not a part of GDP, because GDP measures the value of currently produced goods and services. So when one person is sale to another person, something like that, that is already included in GDP. So that reflects the transfer of an asset, not an addition of the economy's income. Thus, the sale of a good used good is not included as a part of GDP. So treatment of inventories. Imagine that a bakery hires worker to produce more breads, pay their wages, and then fails to sell the additional bread. How does this transaction affect the GDP? The answer depends on what happened to the unsold bread. Let's first suppose that the bread spoiled. In this case, the firm has paid more in wages but not received any additional revenue, so the firm's profit is reduced by the amount that wages have increased. Total expenditure in the economy has not changed because no one buys the bread. Total income has not changed either, although more is distributed as a wages and less is profit, because the transaction affects neither expenditure nor income. It does not alter or does not change GDP. Now suppose that instead that the bread is put into inventory to sold later. In this case, the transaction is treated differently. The owners of the firms are assumed to have purchased the bread for the firm's inventory, and the firm's profit is not reduced by the additional wages it has paid, because the higher wages raise total income and greater spending on inventory raise total expenditure. The economy's GDP rise. What happens later when the firms sell the bread out of inventory? This case is much like the sale of a used good. This is spending by the bread consumer, but there is inventory disinvestment by the firm. This negative spending by the firm offset the positive spending by the consumer. So the sale out of inventory does not affect GDP. The general rule is that when a firm increases its inventory of goods, this investment in inventory is counted as an expenditure by the firm owner. Thus, the production for inventory increases GDP just as much as production of final sale. A sale out of inventory inventory, however, is a combination of positive spending and negative spending, so it does not influence GDP. This treatment of inventory ensures that GDP reflects the economy's current production of goods and services. While talking about the intermediate goods and value added, okay, many goods are produced in different stages, like raw materials are processed into intermediate goods by one firm and then sold to another firm, or final processing. How should we treat such product when computing GDP? For example, suppose a cattle owner sell 1/4 pound of meat to the McDonald's for 0.5, and then McDonald's sell you a hamburger for $1.5. So GDP include both the meat and the hamburger is the main question. To answer is that GDP include only the value of final product. That the hamburger has included the price of meat and the price of hamburger as well. So GDP increases by $1.5, not by the $2. The reason is that the value of intermediate good is already included as a part of market price of the final good in which they are used. So to add the intermediate goods to the final good would be double counting. So that's why the meat would be counted twice. Hence GDP is the total value of final goods and services produced. So here we have the other rule that housing services and other importations, although most goods and services are valued at their market prices when computing GDP, some are not sold in the marketplace and therefore do not have market price. If GDP is to include the value of these goods and services, we must use an estimates of their value, such as an estimate is called imputed value. So imputations are especially important for determining the value of housing. A person who rents a house is buying housing services and providing income for the landlord. The rent is a part of GDP both as expenditure by the renter and as an income for the landlord. Many people, however, live in their own homes. Although they do not pay rent to the landlord, they are enjoying housing services similar to those that rented purchase. To take account of the housing services enjoyed by the home owners, GDP include the rent that these homeowners pay to themselves. Of course, homeowners do not in fact pay themselves this rent. So the Department of Commerce of different countries estimate what the market rent for a home would be if it were rented, and includes that imputed rent as a part of GDP. This imputed rent is included both in home owner expenditure and in the homeowner's income as well. Okay, imputation also raises in value government services. For example, police officer, firefighters and senator provide services to the public. Giving to a value of these services is difficult because they are not sold in marketplace and therefore do not have a market price. The national income accounts include these services in GDP by valuing them at their cost. That is, the wage of these public servants are used as a measure of value of their output. In many cases, an imputation is called for the principle, but to keep things simple is not made in practice because GDP includes the imputed rent on owner's occupied house. One might expect it also to include the imputed rent on cars, lawns owners, and jewelries and other durable goods owned by the household. Yet the value of these rental services is left out of GDP. In addition, some of the output of the economy is produced and consumed at home and never enter the marketplace. For example, meals cooked at the home are similar to meals cooked at the restaurants, yet the value added in meals at home is left out of GDP. So here we have no imputation is made for the value of goods and services sold in the underground economy or black market. The underground economy is the part of economy that people hide from the government, either because they wish to evade taxes or because the activity is illegal. Examples include domestic workers paid off the books and illegal drug trades. The imputations necessary for computing GDP are not only approximate, and because the value of many goods and services is left out altogether. GDP is an imperfect measure of economic activity. These imperfections are we can say that most probabilistic when comparing standard of living across countries. The size of underground economy, for example, varies widely from country to country, yet as long as the magnitude of these imperfections remain fairly constant over time, GDP is useful for comparing or computing economic activity from year to year. While real GDP versus nominal, economists use the rule just described to compute GDP, which value the economy's total output and goods and services, but GDP is a measure of economic well-being. Consider, for example, here once again the economy that produce only apples and oranges. In this economy, GDP is the sum of the value of all apples produced and the value of all oranges produced. That is, like, we have GDP is equal to the price of apples multiplied by price of quantity plus price of oranges multiplied by price of quantity of oranges. The economists call the value of GDP, value of goods and services measured at a current price, or we can say that nominal GDP. Notice that nominal GDP can increase either because price rise or because quantities rise. It is easy to see that government computed this way is not a good measure of economic well-being. That is, this measure does not accurately reflect how well the economy can satisfy the demands of household firms and the government. If all prices double without any change in the quantity, nominal GDP would be double. So yet it would be misleading to say that the economy's ability to satisfy demands has double because the quantity of every good produced remains the same. So here we have a better measure of economic well-being, would tally the economy's output of goods and services without being influenced by changes in price. For this purpose, economists use real GDP, which is the value of goods and services measured using a constant set of price. So that is a real GDP shows that what would have happened to expenditure on output if quantity had changed but prices has not. So see how real GDP is computed. Imagine we want to compare output in 2009 with the output in subsequent year of our apple and oranges economy. We could begin by choosing a set of prices called a base year year price, such as prices that prevailed in 2009 goods and services, are then added up using these base year price to value the different goods in each year. Real GDP for 2009 would be as prices of apple in 2009, quantity of apples in 2009, prices of plus prices of oranges in 2009, and quantity of oranges in 2009. So real GDP of 2010 become as real GDP is equal to prices of apple in 2009 multiplied by quantities of apple in 2010, prices of oranges in 2009 multiplied by quantity of oranges in 2010. So like that, real GDP in 2011, prices of apple in 2009 multiplied by quantity of apple in 2011 plus prices of oranges in 2009 multiplied by the quantity of oranges in 2011. Notice that 2009 prices are used to compute the real GDP for all 3 years because the prices are held constant. Real GDP varies from year to year only if the quantities produced vary, because a society's ability to provide economic satisfaction for its member ultimately depends on quantity of goods and services produced. Real GDP provides a better measure of economic well-being than a nominal GDP. So chain weighted method. While here we have previously we have discussed the base year method of real GDP. Here we have the chain weighted measure of real GDP. We have been discussing the real GDP as if the prices used to compute this measure never change from their base year value. If this were truly the case, over time the price would become more and more dated. For instance, the prices of computers have fallen subsequently in a recent year, while the prices of a year at a college has risen. When valuing the production of computers and education, it would be misleading to us the price that prevailed 10 or 20 years ago. To solve this problem, the Bureau of Economic Analysis used to update the prices on different periods to compute the real GDP. About every 5 years, a new base year was chosen. The price was then held fixed, and then they are used to measure year-to-year change in the production of goods and services until the base was updated once again. While talking about the chain-based method of real GDP, in 1995, the Bureau announced a new policy for dealing with the changes in the base year. In particular, it now uses chain-weighted measures of real GDP. With these two new measures, the base year changes continuously over the time. In a sense, every price in 2009 and 10 are used to measure real growth from 2009 to 10. Average price in 2010 and 11 are used to measure the real growth from 2010 to 2011, and so on. These various year-to-year growth rates are then put together to form a chain that can be used to compare the output of goods and services between any two dates. So the chain weighted measure of real GDP is better than more traditional measures because it ensures that prices used to compute real GDP are never far out of date. For most purposes, however, the difference are not significant. It turns out that the two measures of real GDP are highly correlated with each other. As a practical manner, both measures of real GDP reflect the same thing: economy-wide changes in the production of goods and services. Here, components of expenditure. Economists and policymakers care not only about economy's total output of goods and services, but also about the allocation of this output among alternative uses. The national income accounts divided GDP into four broad categories of spending. First one is consumption, second one is investment, and then government purchases, government expenditure, or G, or net export. With the help of these four broad categories, we can construct the GDP function like we have y is equal to c plus I plus g plus nx. So GDP is the sum of consumption, investment, government purchases, and net export. Each dollar of GDP falls into one of these categories. This equation is an identity, an equation that must hold because of the way that variables are defined. It is called a national income accounts identity. By talking about the consumption, here we have the consumption. Consumption consists of goods and services bought by the household. It is divided into three subcategories: non-durable goods, durable goods, and services. Non-durable goods are goods that last only a short period of time, such as food and clothing. Durable goods are goods that last a long time, such as car and TV. Services include the work done for the consumer by individual and firms, such as haircuts and doctor visits. By talking about the investment, it consists of goods bought for the future usage. Investment is also divided into three subcategories: business fixed investment and residential fixed investment and inventory investment. Business fixed investment is the purchase of new plants and equipment by the firm, while the residential investment is the purchase of new housing by the household and landlords. Inventory investment is the increase in firm inventories of goods. While talking about the government purchases are the goods and services bought by the federal, state, or federal government or local government. This category include such as military equipment, highways, and the services produced by or provided by the government workers. It does not include transfer payments to individuals such as social security and welfare benefits, because transfer payments reallocate the existing income and not made in exchange for the goods and services. They are not part of GDP. While talking about the net export, the net export account for trade with other countries. Net exports are the value of goods and services sold in other countries. We call it an export minus the value of goods and services that foreign country or foreigner sells. We call it imports. So net exports are positive when the value of our export is greater than the value of our imports, and negative when the value of imports is greater than the value of our export. So net exports represents the net expenditure from abroad on our goods and services, which we can say that provide income for the domestic producer. So this is all about, we have discussed about the measuring the value of economic activity with the help of gross domestic product, and we also discuss the measuring the value of economic activity with the component of expenditure method. So see you with another video. Ciao.